Do you know what a dividend reinvestment plan is? And do you know why I don't recommend them? In this episode, we're going to cover exactly that. Hi, my name is Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. In this podcast, we're going to cover 4 things. Number 1, what is a dividend? Number 2, what is a dividend reinvestment plan? Number 3, when is a stock priced high or low? We're going to need to know that before we decide whether or not a dividend reinvestment plan is good for you. And then lastly, we are going to cover why I don't recommend dividend reinvestment plans. Let's get started with what is a dividend. Coca-Cola has a little over 4.3 billion shares outstanding. If you were to buy all of the shares, you would own the entire company. But if you were to buy just 5 shares, 10 shares, or 100 shares, you would still be considered part owner of the company. And as part owner of the company, you're entitled to share in the profits of the company. And those profits come to you in the form of dividends. Basically, you're getting paid to own shares in a company. In this example, if a company is paying a dividend of $1 per share and you own 1,000 shares, you'll receive $1,000 every year for as long as you own those shares and as long as the company continues to pay the dividend. You can spend the dividends if you want, or you can reinvest them. It's entirely up to you. The dividends come directly as cash into your trading account. So now let's take a look at what is a dividend reinvestment plan. A dividend reinvestment plan, or a DRIP, D-R-I-P, means that a company will automatically reinvest your dividends back into their shares and give you more shares instead of paying you the cash dividend. So a DRIP allows you to accumulate more shares over time without investing any new money. So now let's see what that looks like for our investors, Jack and Jill. Now, both Jack and Jill own dividend stocks. And Jack is enrolled in a dividend reinvestment plan. Jill is not enrolled in a dividend reinvestment plan. But they both own shares in the same company. In this example, company ABC. So Jack receives $500 in dividends from his shares in company ABC. Because he's enrolled in the DRIP, he now owns an additional $500 worth of shares in company ABC. So he doesn't get the $500 in cash, he just gets more shares in the company, and those shares are worth $500. Now for Jill, again, she's invested in the same company, so she also receives $500 in dividends, but she's not enrolled in a DRIP, so she gets the cash directly. So the $500 cash is deposited directly into her trading account. Now you can see the difference here is if the stock price goes up, then the value of the shares that Jack owns is going to be worth more than $500, whereas Jill is stuck with her $500 cash. On the other hand, if the stock price comes down, then the value of the shares that Jack owns is now worth less than $500, whereas Jill is still sitting on $500 cash in her trading account. So that's kind of the difference of what happens when the stock price goes up or the stock price goes down. Now, let's go through some of the advantages of owning a DRIP, and then we'll talk about the disadvantage of being enrolled in a DRIP. So here are some of the advantages if you're enrolled in a dividend reinvestment plan. Now, typically there are no commissions. So when you get the extra shares, you don't have to pay the trading fee or the commission fee, typically. So that's pretty good. You can take advantage of dollar cost averaging, which means that whether the shares go up in price or they go down in price, you're automatically getting new shares in the company every time the company pays a dividend. Most companies pay every quarterly. Some of them pay every monthly. So depending on the company's schedule of paying dividends, you are going to be getting more shares in that company. So you can sort of dollar cost average over the long term. And the other advantage is it's automatic. So you don't have to really do anything. Once you've bought the shares initially, and then you enroll yourself in a dividend reinvestment plan, there's nothing else for you to do. You just have to hold on to those shares, and every month or every quarter, whenever the company pays a dividend, you're just going to get more shares in the company. So it's automatic, which a lot of people like. Now, what is the disadvantage? So the biggest disadvantage of being enrolled in a dividend reinvestment plan is that you are inadvertently buying stocks when they're priced high. So how do you know when a stock is priced high? How do you know when it's priced low? We're going to show you that right now. We're going to cover that in our next topic right here. When is a stock priced low or high? So let's go through that right now, and you'll see when a stock is priced low or high. So the dividend yield is really simple. It's the annual dividend divided by the stock price. So in this example, and you can see it up on the screen, if a company is paying an annual dividend of $1 per share and the share price is $20 and you happen to buy the shares today at $20, so 1 over 20 expressed as a percentage is 5%. So 5% is the dividend yield. This is the return on your investment as you hold on to your shares. So that's pretty good. You can make 5% return every year just by owning these shares in this example. Now, let's say you didn't buy the shares at $20. You waited a couple of days or you waited a couple of weeks and the stock price dropped to $15. So now we take the dividend divided by the stock price today, which is 15. So 1 over 15 expressed as a percentage is 6.7%. Now, let's say you waited a little bit more, a couple of more days, weeks, and the stock price continued to drop, and the stock price dropped to $10. Now the dividend yield is 10%, right? Again, the dividend divided by the stock price. So 1 over 10, now it's 10%. And if the stock price dropped even further to $5, now your dividend yield is 20%. All things considered equal, would you rather make 20% a year or would you rather make 5% a year? Right? So I'm sure everyone's going to agree it's better to make 20% a year. Now, these numbers are really big, but we've kept it that way just to keep the math simple. What I'm trying to illustrate here is you'll notice that as the stock price continues to drop, the dividend yield goes up. So the stock price started at $20, went down to 15, went down to 10, went down to 5. As the stock price kept dropping, the dividend yield went from 5%, 6%, 10% to 20%. So this is really important. So I'm going to say it again. As the stock price starts to drop, your dividend yield goes up. And what happens is if you were going to invest $1,000 or $10,000 in this company, at $20, you're going to be able to buy a number of shares. But at $5 share price, you're going to be able to buy way more shares. And remember, the dividend is paid based on the number of shares you own. So if you can buy more shares because they're cheap, you're going to get more dividends. And that's why in this example on the screen, when the price is $5, you're going to get a 20% yield. When the price is $20, you're only going to make 5% yield. Okay? Now, the opposite is also true. As the stock price starts to creep back up again, your dividend yield is going to come down. So the dividend yield would go from 20% to 10 to 6 to 5 as the stock price started creeping back up from $5 back up to $20. Well, let's see what that looks like in real life. So here we're looking at an example of a company. You can see the stock prices go up and down all the time. So the blue line is just going up and down. And we're looking at the last 20 years. So the stock price history over the last 20 years. So what if I was to tell you that for this company, the 20-year average dividend yield is 3%. So that's the orange line. You can see that cut right through the graph. So that's your average dividend yield at 3%. Now, what if I was to tell you that the dividend yield today, the current yield, is 5%? Remember, the yield is your dividend divided by the share price. So today the share price is whatever it is today. the current yield is 5%. When you compare the 5% to the 3%, which is the average, you'll notice that the current yield is higher than the average dividend yield. And remember, when the dividend yield goes up, it means the stock price has come down. And that's your buying area right there, below the orange line. That's when the stock is going to be undervalued. In this example, any yield higher than 3%, because we told you the 20-year average dividend yield for this company is 3%. So any yield today that's higher than 3% tells you that the company is priced low or undervalued. That's your buying area below the orange line. So this is what the formula looks like, and it's really simple. If the current dividend yield is greater than the company's 20-year average dividend yield, then the stock is undervalued or priced low. Now, what if I was to tell you that the current dividend yield today is just 1%? So now you take a look at the current yield and you compare it to the average. 1% is less than the average of 3%. And remember, when the dividend yield goes down, which in this case it has, it's gone down from its average of 3% down to 1. When the dividend yield goes down, the share price has gone up. And now the share price is anywhere above the orange line. And the stock is overvalued. So this is what the formula looks like. If the current dividend yield is less than its average dividend yield, then the stock is overvalued. So now let's put this up on the screen. Again, we're just going to repeat what we just said, but this is really important. If the current dividend yield is greater than its average dividend yield, then the stock is undervalued. I've been a dividend investor for over 22 years. I have never bought a stock when it was priced high or overvalued, right? Always buy stocks when they're priced low. And they're quality stocks, and we'll talk about quality in a couple of minutes. But just looking at the stock prices, you want to buy low. Everyone's heard the phrase buy low and sell high. Now we've shown you exactly when to figure out when a stock is priced low. And so just to repeat the second formula, if the current dividend yield is less than this 20-year average dividend yield, then the stock is overvalued. And if a stock is overvalued or priced high, skip it. Move on to something else. That means if you see the stock is priced high, it means the company is overvalued, which means you need to avoid it for now. Don't invest in companies that are priced high. So now let's get to our last topic here. Why I don't recommend dividend reinvestment plans. And the answer is simple. It's because of the disadvantage I showed you earlier. When you're enrolled in a dividend reinvestment plan, you are inadvertently buying stocks when they're priced high, because stock prices go up and down all the time. And I just showed you this previous slide. You never want to buy a company when it's priced high. Always stick to stocks that are undervalued. And why is that? Well, let's take a look at this. You can see it on the screen here. Stock prices go up and down all the time. In this example, a stock is undervalued at $14 and it's overvalued at $51. So assuming you've bought the stock when it was 14 because it was undervalued, it was priced low, that's good. But then if you got into the drip, what happens when the stock price goes up to $51 or $60 or $80? I don't want to be buying this company when it's overvalued. So I don't want to be buying more shares when they're at 51, 60, 80, 90 or $100 or even $200. I don't want to buy any more because they're overvalued then. But with a drip, you have no choice. The company will automatically reinvest your dividends back into their shares, and whatever the share price happens to be, whether it's low or high, you're going to be getting more shares. And at the high price, we don't want to be buying more shares. So what's the solution here? The solution is to accumulate your cash dividends. They get deposited into your trading account automatically. Let the cash accumulate. Then when you're ready to invest, so you've got $500 in there, or 1,000, 2,000, 5,000. I have some clients who wait till they have 10,000 in cash. So that's going to depend on where you are in your portfolio size. But when you have enough cash, then I would suggest to invest in whatever stock is a quality stock and it's undervalued at that time in the future. Now, the biggest question I get whenever when I say that I don't recommend drips is most people will say, well, without a drip, isn't my money just sitting in my trading account earning nothing? So the short answer is yes, you're not going to get much. The interest rate in a stock trading account is not that high. I know interest rates have come up recently, but any cash sitting in there, you might earn a little bit of interest, but not much. But what's the alternative? Is the alternative to enroll yourself in a drip and then inadvertently buy stocks when they're priced high? No. I don't recommend that. That's more disadvantage. It's worse for you to do that than it is to sit on cash. There isn't any harm in sitting on cash. And look, you're not going to be sitting on cash for a very, very long time. What I'm suggesting is let the dividends accumulate as cash in your trading account. And when you've got $500 in there, or 1,000 in there, or 5,000 in there, and you're ready to invest, then go ahead and invest in whatever is undervalued then. So the cash, you're not going to be sitting on cash for an extremely long time, but that's a safer option. It's safer to do it that way than to be buying stocks when they're priced high, right? I gave you the example before. If you bought a stock at $14 because it was low, that's good. You don't want to be buying it when it's at $100 a share. It's way overvalued. So better just to keep that dividend as a cash in your account. So let's get back to the solution. Accumulate your dividends. Then when you're ready to invest in whatever stock is a quality stock and undervalued at that time. Now, how do you know when you're looking at a stock if it's a quality stock? And how do you know when you're looking at it if it's undervalued or priced high? So for that, I've created what I call the 12 rules of simply investing. Before you invest in any company, make sure it passes all of the 12 rules, not just 10 of the rules or 9 or 8, all 12. The rules are designed to minimize your risk, keep your capital safe, and maximize your returns. Now, for those of you on the audio version, I'm going to list out the rules that are up on the screen here if you're watching the video version. But let's go through the rules very quickly. Rule number 1, do you understand how the company is making money? If you don't, skip it. Move on to something else. Rule number 2, 20 years from now, will people still be using its product and services? Rule number 3, does the company have a low-cost competitive advantage? Rule number 4, is it recession-proof? If it's not, skip it. Move on to something else. Rule number 5, is it profitable? So we look at the earnings per share, last 20-year history. Number 6, does it grow its dividend? We want to see the dividend growing every single year because that's your passive income. We want that to grow every single year. Rule number 7, can it afford to pay the dividend? Rule number 8, is the debt less than 70%? Rule number 9, avoid any company with a recent dividend cut. Rule number 10, does it buy back its own shares? Rule number 11, is the stock priced low? And we just showed you in this video how to figure out when a stock is priced low. So we're going to compare the current yield, dividend yield, to the average 20-year dividend yield. In rule number 11, we're also going to look at the PE ratio and the PB ratio, but we cover all that in there. So we want to make sure a company is undervalued. Rules number 1 to 10 will tell you if this is a quality company, and rule number 11 will tell you if it's undervalued. And again, we want to make sure a company passes all of the 12 rules before you invest in it. Rule number 12, keep your emotions out of investing. So for those of you that are interested, I've created the Simply Investing course. We cover all of the 12 rules in detail with real life examples. It's an online course. You get unlimited access to all of the videos that are there. I also provide you with a Google spreadsheet that you can use. You can put in all of the numbers, all the data. We show you how to do that step by step for any stock anywhere in the world. And we'll show you if a company passes all the 12 rules, which rules it fails, if it's undervalued, so you can figure out what to consider for investing and what to avoid. Now, if you want to go faster, I've created what I call the Simply Investing platform. This is a web application where we apply all the rules for you automatically every single day on over 8,000 stocks in the US and in Canada. So with the platform, you can immediately see which companies are quality companies, which ones are undervalued. We also show you companies that are overvalued, so you know which ones to ignore. So the platform makes it a lot easier to be able to decide what to consider for investing and what to avoid. Now, for listeners of this podcast, keep a note of this coupon code. It's up on the screen. SAVE10. SAVE10. SAVE10 is a very important coupon code. It's going to give you 10% off of every product and service on our website, simplyinvesting.com. So 10% off the course, the platform. We have coaching calls as well, so you can book those. The advantage with this coupon code, especially when it comes to the platform, is as long as you remain an active subscriber, you will save 10% every single month or every single year, depending on which subscription you choose. So you can save 10% for a very long time off of any of those products. So the coupon code again is SAVE10, SAVE10. I want to thank you for watching or listening to this podcast today. For more information, take a look at our website, simplyinvesting.com. If you enjoyed this episode, be sure to hit the subscribe button. We have a new episode out every week. Also hit the like button as well. Thank you again for watching, and I will see you next time.